Hello, everyone. You're watching Resource Talks, and today I'm joined by Peter Schiff, who is a financial commentator and the CEO and Chief Global Strategist of Euro-Pacific Capital. Please remember that although Peter is famous for having predicted the 2007 subprime mortgage crisis, neither he nor I have a crystal ball, so please do your own research before taking any investment decisions. And remember that we may be many things, but we're not your investment advisors. Peter, thank you for being here.
Oh, thanks, Mark, for having me on your show.
So despite the disclaimer I just gave, I think you might have saved hundreds of people millions of dollars in the last few years by pointing out the excesses in the cryptocurrency space. I watched a debate from late 2021 in which you went against the founder of the cryptocurrency exchange Celsius, which has now filed for bankruptcy. And you said over and over again, you must be taking tremendous risks to generate 5% yield on cryptocurrency. And of course, Celsius went under just 6 months after. But Peter, turning to the present day, what do you make of Bitcoin's rally so far in 2023, up about 30% year to date?
Well, first of all, a lot of people would argue that I cost people millions of dollars, maybe more than that, maybe billions, by discouraging people from buying Bitcoin when I first learned about it, which is, it was under $10 a Bitcoin, I think. I never really believed that it would become money, and it still hasn't become money. What, I got wrong was I didn't see the potential for the bubble to get so big that so many people would be taken in by it. And, one of the reasons that I didn't buy Bitcoin when I first learned about it is I didn't understand what stopped somebody else from coming up with another cryptocurrency and saying, buy this one instead. And so I saw a lot of potential competition. And so I didn't see anything that was really unique about Bitcoin if you can simply replicate another cryptocurrency and just give it another name. Now, of course, now there's better than 20,000 of them. So I was right that you could easily replicate it and compete with it, but it didn't matter. The market bought all that stuff. So I just did not see how big this could get, the scale of the pyramid. A lot of people could have made some money if they got in early, but then most people who got in early didn't get out and they're still in. But I know people who did get out and they made a lot of money and they're much wealthier because they gambled on Bitcoin. But the money they made came at the expense of the money that other people lost. So it's kind of like a self-perpetuating Ponzi with elements of a pyramid or a chain letter, stuff like that. In fact, that's what I thought was going on at Celsius when I did that debate with Alex Mashinsky. I didn't even really know who the guy was, and I didn't know anything about Celsius. But as soon as I heard the guy talk, it became pretty obvious that there was some fraud going on, and it reminded me of a Ponzi. And it turns out that probably that's what he was running. He was paying the yields, not so much with risk. He was just taking the money from the new investors and using it to pay the yield to the old investors, because I knew that you can't just generate yield on a cryptocurrency without doing something. You either have to loan it out, in which case you may not get it back. Who are you lending it to and what kind of risk are you taking? Or you're just trading it and trying to generate a profit, but of course you may generate a loss in pursuit of that profit, or it could just be a pure scheme. I don't know, which it was at Celsius or if it was simply, a combination of all three. But I knew there was no way they could pay these yields. And he was claiming it was safe, that there was no risk, which of course should be an immediate red flag. I don't know how regulators, supposedly we have all these regulators, yet the guys out there on the internet, I could figure out it was a scam in just a couple of minutes. The SEC's got all these resources. I mean, they did nothing. They wait until everything collapses and everybody already lost all their money. The reason that Bitcoin has rallied in 2023, I mean, you could try to guess why. I mean, obviously, there was a lot of pessimism, not nearly as much as there should have been, but there was at the end of 2022. So, the market's kind of confounded the people who were negative with a big rally. But that's the case with all of these beaten down high risk assets. And, I put quotes on assets when I talk about Bitcoin. But all the speculative stuff that really got clobbered, and deservedly so, in 2022, all that stuff rallied in January. It wasn't just Bitcoin. Everything went up. I mean, Cathie Wood all of a sudden is, top of the hill again. She's out there touting her fund because of this big January. But I think all of this stuff is going to reverse and make new lows. This is just a sucker rally. It's maybe a Santa Claus rally come late. But it's short covering. This is not going to be sustainable. I think the trends that were established in 2022 are going to continue and maybe even accelerate in 2023. And that is everything deflating, all of these bubble, momentum growth oriented assets that people were buying with cheap money because it was 0% interest rates and supposedly no inflation. I think the bloom is off that rose. And, we have a long way to go to unwind that trade, because the trade was on for a better part of a decade, where we had 0% rates and the idea that inflation would always be low. And now that rates are much higher and they could continue to go higher, I don't think we're going down to zero anytime soon. And inflation is going to stay high. So it's a whole new ballgame when it comes to investing. So, that's, what I like, because I'm a value guy. I like to buy companies that have good earnings and pay good dividends. And those type of stocks were out of favor for the past 10 years, which allowed me to buy them pretty cheap. So I'm glad I'm sitting on quality portfolios of assets that I think have a lot of room to go up in price as they continue to pay good dividends. The problem with all these momentum stocks is they pay nothing. It's all a bet. It's all a gamble on growth. But if you don't get growth, you've got nothing to show for your investment.
Just going back to Bitcoin briefly, I mean, I think if there's a public figure out there who's harsher about Bitcoin than you, that would have to be Warren Buffett, who said that for all of the Bitcoin in existence, he wouldn't pay even $25. And his criticism boils down to the fact that, as you said, cryptocurrencies are like a chain letters or Ponzi scheme, and they don't produce any yield, unlike dividend-paying stocks or rent-paying properties. However, Warren Buffett has also said many unflattering things about gold for exactly the same reason. And he once referred to gold as a useless cube and a non-productive asset. So as a notorious gold bug, how would you respond to Mr. Buffett's criticisms of gold?
Yeah, well, I think Warren Buffett would look at gold differently if he was more worried about inflation and a currency crisis. I think Warren Buffett has an appreciation for gold in that respect. I think when you're looking at gold relative to assets, I think you're making a mistake, as I would agree that it is a non-productive asset. It's not a business. Warren Buffett likes to buy businesses that generate income and pay dividends, and gold doesn't, neither of those things. So you don't need Warren Buffett if you want to buy gold. He's, out there as a value manager trying to find good values and buy businesses. And so he's not interested in gold. But gold does not compete with real estate or stocks or bonds. Gold is a commodity, and it's useful as a commodity, just like all the other commodities out there. I mean, and Warren Buffett understands the usefulness of commodities. But gold represents a monetary commodity, monetary metal, that competes with dollars, that competes with euros, that competes with yen. And so if you asked Warren Buffett, you need to take $1 million and bury it in the ground and leave it there for the next 10 years, would you bury US dollars? Would you bury Japanese yen? Would you bury euros, or would you bury gold, right? He would clearly pick gold, right? And that's what you need to compare gold to. You can't compare it to an income generating asset. The only way you can generate income on your gold is to loan it out, which you could do. You can loan your gold and you can get interest on that loan, just like if you have dollars. You don't generate any yield on dollars unless you take risk. You have to loan them out. Now, you can loan your dollars to the U.S. government, and people think that that's risk-free. You could buy U.S. treasuries, but it's not the dollar that's generating the yield. It's the fact that you've loaned those dollars to the government, and you're taking some risk, and now they're paying you a return. You can do the same thing with gold. You can make a loan denominated in gold. So that's what you have to look at gold. Gold, Warren Buffett is trying to compare it to the wrong things. Now, of course, Warren Buffett, as an investor, can look around and survey the opportunities. What happens if you don't see any value? What happens if you think stocks are expensive, if you think real estate is expensive, and you don't want to buy it? You want to wait for the prices to come down and then buy at a more attractive valuation. Where do you store your dry powder? And see, there, I think Warren Buffett might concede that gold would be a better store of value while you're waiting for real estate or stock prices to fall than US dollars, especially given the rate that we're creating them and the size of our budget deficits. I remember, I don't know, about a decade ago or more, Warren Buffett wrote an article that I read. I forget what publication it was in, but it was about a country called Squanderville, and they issued a currency called Squander Bucks. And, that's supposed to be the United States. So he understands. And I've heard Warren Buffett define inflation as a tax. He said inflation is the most misunderstood word in the English language. He knows that inflation is an expansion of the money supply, that it's not rising prices, and he knows it's a tax. So he understands inflation. He understands that central banks may repudiate obligations through inflation. So given his understanding of money and inflation, I would think that Warren Buffett understands the role of gold. And he certainly can distinguish between gold and Bitcoin. Because if you asked him, you have to have something for 10 years. I mean, he'd take dollars over Bitcoin, but he would take gold, I think, over both.
So clearly you see a role for gold in a portfolio. But how would you decide what proportion to allocate to it? I mean, what factors would feed into that decision? For example, there's the famous golden butterfly portfolio allocation, which is, I think, 40% equities, 40% bonds, and 20% gold. Is that the sort of allocation that you would have in mind if you were making a portfolio from scratch?
Well, everything depends on the price. So if you are in a situation where you can buy stocks cheap, there's a lot of value in the stocks and you can get a lot of yield, then you'd want to have more stocks in your portfolio and less gold. But if you're in a situation where the stock market's in a bubble and everything you like is overpriced, then you'd want to have less stock and you'd want to have more in gold. I don't think it's like cut and dry. It just depends on where you are in these cycles. If bonds are expensive, then you don't want to buy them. You might not want any bonds in your portfolio. Like when you had negative interest rates or 0% interest rates, and you had these 30-year bonds yielding less than 2% or 2%. Why would you want to have any of those in your portfolio? I mean, your allocation should be zero, right? So then what do you do with the money that you would have normally put into bonds? I was advocating dividend-paying stocks. But to the extent that those stocks become too expensive and the yields are too low, then you might want to have more in gold. But the reason that people hold gold is other commodities are far more difficult to hold on to. That's the benefit of gold, is that it's easy to store and it doesn't lose any of its properties while you're storing it. Gold maintains all of its value. It doesn't decay. It doesn't rot. So, rather than storing bushels of soybeans or barrels of oil, you can store ounces of gold. It's much easier. And as long as you have gold, you can buy soybeans, you can buy oil, right? You can do that. There's a historic relationship between commodities. And if you have a lot of inflation where money is losing value, then you can always buy your wheat and your oil with gold. You don't know if you're going to be able to buy anything with paper dollars. I mean, you can buy it now, But what happens when the confidence goes away? Because it's just a confidence game. That's the same thing with cryptocurrencies, except it's even easier for the confidence to go away because you don't have a central bank or a government behind it. It's not legal tender. You don't have all the institutions that are engaged. You don't have commerce being conducted. You don't have insurance policies and bond markets and everything that we have right now that are helping to instill confidence that the dollar will have value. Now, that doesn't mean that confidence can't be shaken or lost. It will be. There's no fiat currency that has survived, that test. I mean, eventually it collapses. And so the dollar will be no exception. The only question is how many more days are left or how many years or whatever before the dollar eventually trades for its intrinsic value, which is zero. But Bitcoin, I think, will get there a lot quicker than the dollar because it's so much easier for the confidence to go because it's only been around for a little over a decade. And, when people decide they don't want it anymore, that's it because there's no, real use for it. I keep trying to tell these Bitcoin guys that it's not digital gold because there's no real world use for gold where you can substitute Bitcoin. Right? If I want to, make a gold bracelet, I can't use Bitcoin. If I want to make a computer chip, can't use Bitcoin, right? Gold doesn't have any properties that make it a substitute for gold. Doesn't have any properties that make it a substitute for anything. All you could do with Bitcoin is buy it, or sell it to somebody else. But why would that other person want to buy it? Well, because he thinks that somebody else will pay more for it. It's just a greater fool principle. But underlying that is nothing. It's digital nothing. Yeah, it sounds all sexy, because it's the internet and it's got a great story. When I was in the investment business, I still am, but I got started, there was an old saying, you sell the sizzle, not the steak. Well, with Bitcoin, there's no steak at all. So it had to really sizzle so people wouldn't realize that there was nothing to eat there. But people got hyped up on it and people were making money on it, which is always the case early in a Ponzi or in a pyramid. The guys that get in early make a bunch of money, and then the guys get in late think they're going to also make a bunch of money, but they can't. Doesn't work anymore. There's not enough people left for the people who got in later to make money. But it's interesting though because the people who have been getting in recently still think they're early. They think, oh, we're getting in on the ground floor. It's like you're nowhere near the ground floor. You're at the top of the Empire State Building. There's not much room left. Yeah. But then the whole thing implodes. And then Warren Buffett could be right. All 21 million Bitcoin may not be worth $25. If nobody wants them, you can't do anything with them. So what good are they? But, I keep telling people, it's not even Bitcoin. It's Satoshis. People want to talk about how there's only 21 million Bitcoin. Yeah, there's 2.1 quadrillion Satoshis. That's what you're talking about. Because a Bitcoin is just an arbitrary bundle of 100 million Satoshis. But, what's the difference between a Satoshi and a Bitcoin? Nothing. There's just, other than numbers, because you can't do anything with a Bitcoin. And so you can't do anything with a Satoshi. It's like people say, well, Peter, how many grains of gold are there in an ounce? I say, well, but it doesn't merely make a difference. If you need an ounce of gold, you need an ounce of gold. A grain won't do it. It's not enough metal to do what you need to do. But since you don't need to do anything with Bitcoin, doesn't matter how many you have. I can have one Satoshi and I can do as much as somebody that has a Bitcoin. I just don't have as much to give away. But when you take that out of it, I've got the same thing. So there's tons of Satoshis out there. Literally there's enough for everybody to have 300,000 or 400,000. Every human being that is alive on the planet can have several 100,000 of these things if they wanted them. But why would eventually no one's going to want them?
Yeah. Well, it's going back to the topic of gold though, and talking of supply. Do you think that gold investors should worry about the risk of massive previously undiscovered gold supplies coming online? Because last year, the Ugandan government made a bit of a splash when they announced that exploration surveys in their country had uncovered supposedly $12.8 trillion worth of gold deposits. And that's huge. To put it into perspective, it's about the same as the current estimated market cap for above ground gold reserves. So is that something that people should take into consideration before buying gold?
Not really. I mean, that was all a bunch of BS. I mean, they don't have that kind of gold over there. The Bitcoin guys were spreading rumors about a year or two ago about some golden asteroid that supposedly was, not too far from Earth. And maybe Elon Musk was going to go and salvage it or something and start mining it and bring all the gold home. And gold was going to be worthless. I mean, they're always trying to scare you into thinking that, gold is abundant, that it's not really scarce. But, gold production has actually declined. I mean, we've been producing relatively little in the way of gold over the past decade compared to previous decades. So, we're not finding new sources of gold. I mean, maybe they're there, but we haven't found them yet. So, gold is pretty scarce, and it will likely stay scarce in the foreseeable future. I mean, well beyond my lifetime and the lifetime of my children and my grandchildren and probably their grandchildren. I don't see us being able to, just create gold, just, magically, through some new science, not magic, but it's just some way to synthesize gold in a way that is cheaper than mining it. But gold has very unique properties, and there are a lot of uses for gold. In fact, there's more uses for gold today than at any time in history. And in fact, as we continue to advance as a civilization, we will probably discover more uses for gold than exist today. So I think demand is going to be there in the real world, which is ultimately what gives gold its value. But I also think that we are headed for a monetary crisis in the world, a dollar crisis, and that will be at the epicenter of it, but it will ripple out through the fiat world. And I do think that we will return to a gold standard. I just don't see any other viable monetary system to replace what we have, because what we have will fail. And I don't know that it will just be replaced by a new version of a fiat system, because I don't see how that's going to be sellable to the public that just got wiped out by fiat currency. So I think we have to return to something of real value. And even if governments don't do this on their own, I think the private sector will. I think we're going to see the remonetization of gold. And the one thing that may, I guess, piss off a lot of the Bitcoin people who were so certain that blockchain was going to kill gold, I think blockchain is basically going to give gold a new lease on its monetary life by making gold an even more viable medium of exchange, unit of account, than it was in the past. Blockchain, the internet, will add to gold's value in that it will be easier for people to conduct commerce in gold. Because if you go back and think about the original currency, paper money, how did it come about? It came about because the private sector, not the government, the private sector wanted a more convenient way to transact in gold. So they would take their gold and they would deposit it first in a block with a blocksmith, and then with a goldsmith, and then with a bank, right? Or blacksmith rather, yeah. And then with a bank, but the bank would issue notes that were backed by gold, and the notes in and of themselves, the currency had no value. What gave it value was that they represented ownership in actual gold, and the bank, would pay to the bearer on demand, however much gold was, called for by the note. And so instead of circulating the gold, we would just circulate the notes because it was more convenient to use paper bills than gold bars. So I think blockchain improves on that dramatically. Whereas you can take a bar of gold that's in a vault and you can tokenize it, and you can create however many tokens that you need. Maybe a token is a gram of gold, and you can create all these tokens that can be divisible many, many decimal places over. And the bar of gold kind of stays in a vault, and we just transact in the tokens that represent ownership of that bar. So now if I want to buy a cup of coffee from a barista who wants to sell me some coffee, and let's say it's the equivalent of $5, or however many grams of gold would be $5 for that cup of coffee, I just transfer it to him from my wallet to his wallet, or from a debit card or wherever we want to use the internet to transfer title, right? I just transfer my ownership by transferring the tokens. The gold doesn't go anywhere. It just sits in the same vault, but now that portion of my gold has been transferred to the barista who sold me coffee. And now I have coffee and he has some gold, and we complete a transaction. And that can be done almost instantly using the current technology, much faster, much cheaper than it could if I tried to pay in Bitcoin. Of course, if I tried to pay in Bitcoin, the transaction would be more expensive than the coffee. And by the time the seller got the Bitcoin, the coffee would be cold, right? So much easier, much better to use gold than Bitcoin. And of course, gold is real money. Gold can be a viable medium of exchange, unit of account. Bitcoin can never accomplish that because it doesn't have any actual value. And so it's far too volatile to be used as a currency. And who the hell is going to store it? Because you have no idea what, if anything, it's going to be worth.
You spoke at Rick Rule's Silver Boot Camp on the 11th of February. Would you be able to share the headlines with us? I believe the title of your talk was Hi-Ho Silver, When Gold Charges, Expect Silver to Take the Lead.
Yeah, I just did that. I think that was yesterday.
Oh.
But I know, and I see on your channel that you've had Rick on quite a few times to discuss resources. He's probably the best guy out there on the topic. He's been doing it for a long time. But yeah, he decided to have the silver conference. So obviously I tried to tailor my message a little bit more towards silver than I normally would. I normally kind of talk about gold, but it just goes, it follows that if gold does really well, you would expect silver to do even better. And so that's how I look at it. I think that if I'm right about what's going to happen to the price of gold, then I think the price of silver will go up proportionally more. If I'm wrong, silver could go down proportionally more as well, right? So you got more upside, you got more downside. I mean, in a way, what I'm talking about when it comes to, blockchain and tokenizing gold, that does take away some of the silver demand that might ordinarily be there, in that when we used to transact in gold, when transactions were done for smaller value, we would use less valuable metal. So you would use silver. Like if you look at the US monetary system, we had dimes and quarters. They were made of silver because, if you wanted to buy something for a dime, if you couldn't pay in gold, if the gold coin, they made the coin that small, you'd lose it, right? It would, even a 10th ounce of gold right now is worth about $50 or something like that. And that coin is about the size of a dime. So you really can't get much smaller than that. So you would use silver, but then when you wanted to buy something of an even lower value, silver was too valuable. So then you started using nickel, right? So we had the nickel, or copper. They made a penny out of copper. So you start using these other metals. But if you look at the internet or blockchain, since I can take gold and break it down into tiny increments, then I could use gold to buy everything. I don't need silver or copper or nickel to be part of the monetary system. Every single transaction could be done in gold. So that could take away some silver demand. But those are for transactions that are taking place electronically. I think there's always going to be transactions that are done physically, where people are not engaging for whatever reason in an electronic transfer, where somebody wants to physically pay for something with money in exchange. And there you could see a real increase in demand for silver as the people's money, as the money of choice, when you have, runaway inflation and a lack of trust in central banks and currencies, and, people are looking, for a way to trade with one another. Trading in silver could be very easy, but I also see a lot of demand for silver, as an industrial metal, and not just a monetary metal. And I think copper, commodities in general, and especially metals, they're all going to be going up in the inflationary environment that we're in. And so I would expect to see silver maybe not, make a new high in terms of gold like it was back in 1980 when I think silver got to 50 and gold was 800, right? That was the most expensive gold ever was. But right now gold is very cheap, silver is very cheap relative to gold. And so I would think that the price of silver could double, maybe triple relative to gold, in a big bull market for gold. So gold goes to $5,000-$10,000, the percentage increase in silver could be much greater than the increase in gold.
I read recently that the 50-year average gold to silver ratio is around 57, meaning you'd need 57 ounces of silver to buy 1 ounce of gold. Although currently that ratio is over 80. But do you look at the ratios between gold and silver, or do you think really there's no reason at all for gold to trade at a certain ratio to silver because the supply and demand situation is unique, aren't they?
Well, I think if you look back, and that's all you can do, right? You have to look back and see what's happened in the past and try to extrapolate what might happen in the future. So I think if you look at these historic ratios, they exist for a reason. And even if current circumstances means that silver should be more or less valuable relative to its historic average, I still think that you could look for some type of reversion to those averages. And in fact, I think it should go the other way. So you would think that if silver has been very cheap relative to gold for a number of years, you might expect that it to be expensive for a number of years as well, that the pendulum would swing to the extremes in both directions before ultimately settling back at the middle. So if you're looking at 80-1 in the ratio and the historic average is 50, you might think, but before it settles at 50, it'll go to 30 or 20, right? So you can have a big move in that ratio before it gets back down. But even if it never gets back above 50, that's a pretty big move, especially if the price of gold goes way up.
You said that you're bullish on the commodities complex in general, but are there any specific metals that you would name aside from gold or silver?
Well, I know that I have some personal positions through publicly traded companies in copper, in nickel, and these are the metals that are in demand in batteries. And you can see the trend towards more electric vehicles, and so these vehicles need batteries, and so you need those metals to create them. And so I think you're going to see a lot of these metals much higher in price in order to get the capital invested to start mining them and start looking for more deposits. We haven't had some major discoveries in some time. You haven't had a lot of capital in this sector because that's not where the big money was. People wanted to be in tech, right? And they that's where the big returns were. So that's where capital went. And so it didn't go into building out copper mines. So what's going to cause that is going to be a big increase in price. So that's ultimately going to cause the markets to react. So, and I think the same thing is going to be true with all sorts of resources that really have not seen the type of money flowing into those sectors in the years of 0% interest rates, negative interest rates, QE, the idea that inflation would be low forever. And, I think in that environment, people didn't see the rationale for investing in these commodities, and there wasn't any money for it because it was, being misdirected by artificially low rates and this psychology. But as a result, we're going to end up with big shortages that the markets will eventually correct. But before that can happen, you're just going to see the big increase in price, and that's what's going to send the signals to the market that we need more of these resources, and they have to start spending some time developing them. And the reward is, the high price.
Turning to macroeconomics, you're on the record as saying that you think year-over-year inflation in the US will make new highs compared with 2022, either this year or in 2024. And at the same time, you see the US economy going into recession. But wouldn't it be quite unusual, though, for inflation to go hand in hand with recession? Shouldn't a slump in economic activity depress prices normally?
No, I think if you look around the world historically and you look at the countries that have had the highest inflation, those high rates of inflation are not, correlating to economic success and a lot of growth. In fact, there's no society that's had hyperinflation, where they've had, it's been great. Oh, the things are so great. We have hyperinflation. This economy is so strong that look, prices are going through the roof. Normally, it's the weakest economies that have the highest inflation. And if you look at strong economies that are productive and that are have rising standards of living for the vast majority of people, they have stable prices or falling prices or maybe low inflation, right? So there isn't a correlation between economic growth and inflation that is negative. If anything, it's positive. And so why I believe that inflation is going to get worse as the economy gets weaker is during a weak economy, fewer people are engaged in productive activity. You have more unemployment. And so the economy is not producing as much. And at the same time, governments tend to print more money because people are unemployed and they want unemployment benefits, or more people getting food stamps or welfare. And governments have a tendency to try to stimulate an economy when it's weak, and all they can do is spend more money that they don't have. So I think the monetary policy is going to be far more expansionary during the next economic contraction, and that, I think, is going to fuel the inflation fire that's already burning, and that we haven't even come close to putting out with the policies thus far. I mean, yes, we have seen a reduction, a temporary reduction in headline numbers, as we've seen a response in commodity markets and some markets to the increase in rates that we've had so far. But I think that is going to be short-lived. And now that the dollar is selling off, initially it rallied when the Fed started hiking. Now it's starting to sell off as people think the hikes are coming to an end. But I think as the dollar continues to weaken, that's going to put added pressure, upward pressure on prices in the United States. Certainly it's going to push up the trade deficits as well, which is going to exert downward pressure on GDP. Look, the only way that inflation helps to reduce unemployment is by lowering wages, especially if you have like a minimum wage or something, because inflation basically reduces the minimum wage without Congress having to reduce it. So if you have enough inflation, you end up with a big reduction in the minimum wage, and that's why you get more hiring. Because if you bring down the cost of labor, of course, well, more employers will hire. You'll have more demand for labor as the price goes down. Now, it's much better just to eliminate the minimum wage, and that's a lot easier than trying to use inflation to get rid of it. But politicians, they tend not to want to vote to do those things. So, they secretly undo the mistakes that they've done by creating inflation. But I think the U.S. economy is in a particularly vulnerable position right now because of, more than a decade of this inflationary monetary policy, the enormity of our trade deficits and our budget deficits. So I do think that the next time we try to stimulate by creating inflation, I think we're going to ignite a currency crisis. And so that's going to put an end to this whole process of being able to inflate your way out of one bubble into a bigger bubble. Because the Federal Reserve has solved every problem that it created with inflation. That's the only tool that it has. It creates inflation. Doesn't like to call it inflation, so it calls it quantitative easing because the public doesn't like inflation, and I guess they like quantitative easing because they don't understand it, but it sounds smart. But I think that now that the problem is obviously inflation, well, they're out of tricks because you can't solve inflation with inflation. And that's the dilemma that the Fed is in, and whether it appreciates it or not, but it is the origin of the coming crisis.
According to research by Oxford Economics Group, an advisory firm, the dollar has appreciated by 6% on average over the last 6 recessions since 1973 against a basket of other currencies. So given the US is seen as having the cleanest shirt in the dirty laundry hamper, do you think it's possible that a global recession could actually be bullish for the dollar as investors look to the currency and US treasuries as safe haven assets? Because, as critical as you are of the Federal Reserve, would you really rather hold Japanese yen or euros or Argentinian pesos?
Well, I'd rather hold gold than any of those currencies. But the dollar's already rallied, right? The dollar had a big rally in 2022, despite the big decline in the fourth quarter. It was still up. If you look at the dollar index was up about 10% in 2022. And I think the US did go through a recession in 2022, whether we want to acknowledge that or not. And I think that it's going to deepen in 2023. But yes, the dollar has managed to rally during those recessions. But after the recession ends, the dollar falls. And in fact, the dollar hit a new all-time record low in 2008, just before the financial crisis saved it. But in 2008, in the summer of 2008, it was the lowest it had ever been in history. And then we got a rally, and the dollar sold off again into 2011, but then it didn't make a new low, and then we rallied back, and then we had a pretty big rally recently. But the entire time the dollar has been rallying, the fundamentals that caused the dollar to continue to fall to a record low in 2008 were getting worse. The trade deficits were bigger than ever, setting record after record. The budget deficits were bigger and bigger. National debt higher and higher. And so the problems that led me to worry about the dollar 10, 20 years ago, all those problems haven't been solved. In fact, they're all worse. And so that doesn't mean I'm going to stop worrying about the consequences just because we haven't had the crisis yet. I have to worry even more because now the crisis is going to be that much worse, because all the years that we kicked the can down the road, we allowed the underlying economic fundamentals to get worse for the economy. The structure of the economy is much worse. The size of the bubble is much bigger. And so the damage when it deflates is going to be much bigger. Now, the question is, can we have another rally in the dollar because everybody perceives that it's the cleanest dirty shirt in the hamper? Maybe, but what if some people realize that it's not so clean? That maybe it's actually one of the dirtier shirts in that hamper. Or maybe people decide, you know what, I'm not even going to reach for a dirty shirt. I'm going to put on the only clean shirt around, and that's gold, right? They might realize that, none of these fiat currencies are any good. But, the fact that we had to go to negative rates in Europe and we were zero here, and the fact that the balance sheet is as big as it is, these are all signs that, you're kind of at the end of the road here, right? There's not, more room to go. And as I said, this next downturn, I think, is going to shine a big light on this, because if all of a sudden inflation turns up as the economy turns down, and now the Fed is caught, between a rock and a hard place, and it has to show its hand. It can't just talk. What is it going to do? The economy is collapsing. We may have another financial crisis. People can't pay their bills. The government can't, pay its bills. What is the Fed going to do? Is it going to jack interest rates up to 8% or 10% and just make everything worse in the economy? Politically, I don't even see how it would get away with that. Or is it going to just ignore the fact that inflation is a problem and just accept that as the lesser of the two evils that it has to deal with, and go back to the same policy response of prior recessions or financial crisis, cutting rates, more QE, only when inflation is already double, triple, quadruple its so-called 2% target, and sending inflation to much higher levels. But when that happens, then the world's going to recognize, okay, so there is no more 2% inflation. That's history. Inflation is going to be much higher than 2%, and now everything has to be repriced. The dollar has to be repriced, treasuries, gold, and this is going to be a huge, event in the financial markets, and it's going to have, dramatic, I think, repercussions economically, not only in the United States, but for the whole world, as we move off the dollar standard. Because if we're going to have a high inflationary environment in the United States, there's no way that the dollar can be the reserve currency. So the world needs a new monetary system.
I was looking at the funds offered by Euro Pacific Capital, your investor broker firm, and you offer 5: emerging markets, gold, international bonds, international dividends, international value. Looking at the emerging markets fund, I see that 23% of the holdings are Chinese stocks. And last year, there was a lot of talk about Chinese tech stocks getting delisted from American exchanges. At the same time, China, obviously an autocratic state with deteriorating relations with the West. How do these risks kind of feed into your investment thesis?
Well, a lot of the risks in Chinese stocks are priced into Chinese stocks. So, that's one of the reasons that they're cheap, right? Because of the higher degree of risk. The question is the market pricing in enough risk, or are they mispricing it? And maybe there's not as much risk as the markets think. But in general, it's good to buy things when there's a cloud of uncertainty around them, when people are worried, because that's when you get a better price. If you buy something when everybody agrees it can only go up, well, it's probably already high because everybody knows it's going to go up, so they all bought it, right? And not all Chinese stocks are alike, and a lot of the Chinese stocks are accessed, through markets that are not in mainland China. And to the extent that there were sanctions, these types of companies might not even get caught up in them. But yeah, I mean, there are definitely risks there. I mean, that's why the emerging market fund, I'd say, is high risk. We don't tell people to buy it unless they are willing to assume these risks. But of course, there's added upside potential. That's the whole point of taking risk, right? Because you want to make an intelligent speculation in markets. And with emerging markets, you're speculating on all sorts of things. But even if the Chinese stocks were to go way down, if you have them as part of a diversified portfolio, you can still do really well. You can have other stocks that make up for what you lose in those stocks. Because I mean, the downside, the worst case is a company goes bankrupt and you lose 100%. You can't lose 500%, but you can make 500% in a stock that goes way up, or 1,000%. There's no limit to the upside on the ones that you get right. So you can still end up making a lot of money, and you can't ignore there's a lot of potential in the Chinese economy. I think there's actually a lot of risk in the U.S. that the markets are not pricing in. I think you have a tremendous risk here, both political risk as well as inflation risk, currency risk, taxation risk. I mean, there's a lot of risks surrounding U.S. assets, and U.S. assets are expensive, and they're not pricing in that risk. So I think you've got to look abroad, but I've been focusing on value and dividends for many, many years, and they were out of favor for most of those years. They really kind of came back in fashion last year, and we had our best year in a long time in performance on a relative basis, not on an absolute basis. My value fund and my dividend payers fund only had small single-digit gains in 2022. But in a year where, the NASDAQ was down 30%, it was one of the worst years in history for bonds, but bear markets all around the world, the fact that we made a little bit of money was a good accomplishment. But the reason was of the rotation. I mean, it was the stock selection. And we made money on our stocks, even though they're all foreign. The dollar was up 10%. That means we needed a 10% gain just to break even. And we more than broke even. So the stocks that we owned collectively last year in the value and dividend pair strategies were up more than 10%. to cover the currency losses that we had. So I think these strategies will do a lot better if I'm right about what happens to the dollar in the years ahead, because when the dollar was strengthening, that was a big headwind for these global strategies. But when it starts to weaken, it becomes a tailwind. And, we made up so much ground last year, and even the year before that, we were making up ground, that, we went from like last place to first place. Morningstar, goes from 1 star to 5 stars. And in fact, the U.S. News and World Report a couple of weeks ago, they came out with this ranking of large cap international value, and they looked at 350 funds, and then they picked the top 60 and they ranked them, and they wrote up a little report on each one. And I had number 1 and number 3 of those 60 funds. Now, somehow Goldman Sachs managed to get in between my 2 funds to be number 2. And I'm hoping, can't make a promise, but I'm hoping that I'm 1 and 2. I want to win and place in because I think the pendulum is now shifting in this direction. And the rally in January, I think, is a head fake. We have way underperformed so far this year. I mean, we're positive returns. We actually have better returns so far in January of this year than all of 2022. But everybody else is making money too in 2023. So it's, so on a relative basis, we're not doing as well. On an absolute basis, we're doing better. But I expect that the trends are going to reverse.
Meanwhile, the international dividend and value funds, I was having a look at those, and they're both heavily weighted to British listed stocks, which makes me happy being from the UK. You've got British American Tobacco, Unilever, BP, Shell, Vodafone. But the FTSE 100 hit an all-time high earlier this year. Do you still see it as undervalued?
Well, I don't think Shell and Vodafone are British. But the other 2 that you mentioned are based out of the UK. But of course, British BP or British Tobacco, I mean, they generate revenue all around the world. So they're UK-based businesses, but their revenues are all over the world. So it's not just dependent on the UK economy. But we're just looking more so at the valuations of the business and the sector that they're in, and the fact that their revenue. I mean, even if the British pound were to weaken, that's not going to necessarily reduce the earnings of BP or Unilever, because of where their revenues are coming from. And I also like to invest in companies that have good pricing power. In an inflationary environment, you got to be able to raise your prices. And the ability to raise prices has to do with, the nature of the demand, because customers can just stop buying your products if they're too expensive. But there are certain products that they need to buy. Right? And so if the price goes up, they're not going to stop buying. They may buy a little bit less, but they still have to buy. Like somebody who's smoked cigarettes. I mean, if they were going to quit cigarettes, they would have already quit. And if the price goes up 10% or 20%, they're probably going to keep smoking. Maybe they'll smoke a little bit less, but more likely they'll give up something else so they can keep on smoking. And so what I don't want is to own the businesses that are selling products that consumers can easily do without. And yeah, I mean, there are a lot of things that we don't want to do without, but we can, and if we can't afford it. And I think a lot of these businesses are going to find that out. And, a lot of these companies too are supported by advertisers. And, when their advertisers don't have any money anymore because the customers aren't buying their products, then, the ad revenues go away. So, we don't have a lot of those or any of those really type of companies in the portfolio. Our companies are going to keep on selling products, and they're going to keep on raising their prices, and they're going to keep paying dividends.
Meanwhile, in your international bond fund, 2 of the biggest holdings are Mexico and Colombia, developing countries. Am I right in thinking that, given you foresee a US recession and presumably an easing of monetary conditions, it follows that could lead to capital inflows for emerging market assets as investors go hunting for
those
yields?
those particular countries with still a relatively small percentage of, it's a very well diversified portfolio of bonds. But yeah, we are favoring a lot of the emerging market currencies over just, the developed markets, because I do believe that you're going to see those currencies strengthen as a group against, the more mature, the euro, the yen, the pound. And, we have some of those currencies in there, but we do have a bigger weighting in emerging markets. And also, I've kept my maturities short for many, many years, which worked against me for a while, but over the last couple of years has really helped the funds catch up. And now, to be ahead of the benchmarks, and based on the fact that we lost a lot less than most bond funds. We lost money in the bond fund last year, but a lot less than everybody else.
Peter, thank you so much for taking the time today. How could somebody who is interested in investing in one of your funds do so?
Okay, so first of all, the funds themselves were based off of strategies that I run for clients at my asset management company, Europe Pacific Asset Management. So if you have the resources where you don't need to buy the fund, where you can have your own account that I manage, you can set one up with us at Europe Pacific Asset Management. You can contact us at our website. You can see the URL above my shoulder, and talk to the representatives about having us build and manage a portfolio for you. And we have custom portfolios that can be more tailored to your individual circumstances. But for investors that didn't have enough money to meet the minimums, or for people who maybe don't want to transfer their account to me, they want to work through Schwab or Fidelity or any of the discount brokers of their choice. They just want to keep their money there. I created the mutual funds, because the mutual funds have very low minimums. You can buy my funds. I think it's a $2,500 minimum. They're on pretty much every platform that's out there for discount brokers. And you can buy them in an IRA or your retirement account, as long as it's not one of these where your employer kind of limits what your choices are. But people can buy them anywhere. You can also buy them through my representatives. You can buy them directly through our website, Europe Pacific Asset Management. You can talk to the reps at Europe Pacific Capital and Europe Pacific Asset Management, and we can buy the funds for you. But anybody can buy these funds on their own without having to work through me if they want to. And one of the things that we also offer at Europe Pacific Asset Management is a wrap program, where we will create a portfolio using all 5 funds, and then weight it based on your risk tolerance and your objectives, and then tweak the allocation from time to time based on changes in the market. And so we may decide that, we've had a big rally in the emerging market fund. Let's take some money out of that fund and maybe put a little bit more into the value fund. Or, we just had a big drop in the gold fund. We want to put a little bit more money into my gold fund, so let's take it out of the dividend payer fund. And we'll make these kind of adjustments to the portfolio for you kind of automatically. So managing a portfolio that has all the strategies. And if we think, stocks are very expensive, let's up our bond weighting, we can put a little bit more money into the bond fund, and we can pare back all the equity funds, to do that.
Okay. Listeners can follow your views on the markets on Twitter, where you have nearly 1 million followers. That's at Peter Schiff. And you have a daily podcast, The Peter Schiff Show. I think you've got 900 episodes now. Is there anywhere else people can go to keep up to date with your commentary?
Yeah, I think I'm getting close to 900, not quite, but that's going to be 1,000, I think. Maybe, I don't know, by the end of the year, I might hit my 1,000th podcast episode. But you can listen to my podcast. I generally do 2 a week, sometimes 1, sometimes 3, rarely more than 3, but the 2 seems to be the average. But you can listen to it at schiffradio.com, on my YouTube channel, where I've got about 520,000 subscribers to the YouTube channel. But a lot of people listen to it at Schiff Radio. People listen to it at iTunes or various places where you can listen to podcasts. I am on Twitter quite a bit. I mean, sometimes I'm tweeting, every half hour, every hour. Certain days I just do a lot of tweeting, and some days not so much. But they're pretty much my own tweets. So I'm composing them and reacting to them, and I interact. In fact, if you look at the engagement level on my Twitter account, it's very high. I mean, I've looked at people who have 5, 10 million followers, and look at their typical tweets, and there are far fewer likes or fewer comments or fewer retweets than you'll see with me. So, I mean, all of my followers are natural. None of them were bought, and none of them, so they're all real people, and they engage a lot with each other, not just me. I mean, you'll see somebody comments, and there'll be all sorts of comments on a comment. I don't, even without me getting involved. So I think it's a good Twitter account to follow for that reason, apart from just getting what I say. And I find now, like, I'll read a lot of stories that will end up quoting my tweets. So instead of a reporter having to call me to get a comment, they just look at my Twitter account and they just quote directly from the tweets. So follow me on Twitter. But I'm also, again, I'm Facebook, not doing much on Facebook these days, but I'm there. We put content up. I am on Instagram. I'm on TikTok. So I'm trying to be relevant and get into the lower demographics. So just try to follow me on all the various platforms, because I'm always posting content.
Yeah,
and it's always interesting. Some of it is humorous, but it's all meant to educate people on economics. And so it's important to share this, because there's so much misinformation out there these days in the mainstream media that people really need to rely more on, on independent thought, on podcasts, like what you're doing, what I'm doing, to really get information. Because by the time it's funneled through the mainstream media, it's wrong, and it's more coming to advance a political agenda than to really let people know the truth about what's going on.
Yeah, well, your tweets about Bitcoin are reliably always very humorous. So anyway, thanks for taking the time, Peter.
Somebody actually came up with a program that automatically buys you Bitcoin every time I tweet about it. And of course, when they launched that, Bitcoin was over 60,000. So the people who have been buying my Bitcoin tweets have been, averaging down constantly, and they've lost a lot of money. So it didn't really go the way the programmers thought. But people are still doing it. I see these people. I bought the Schiff. So they would have been better to sell.
Maybe you're the one driving it down in that case. Yeah. All right. Thanks again, Peter, for coming on, and we hope to have you back on in the future.
Oh, thanks for having me.
Cheers.
Take care, Mark.
Bye-bye.